Time now for Hot Picks. If you want to buy Canadian right now, our next guest is an analyst who says he's identified some strong Canadian stock ideas despite the tariff situation we face from the United States. He's got three that are that we will talk about in this program. He says they're mispriced, i.e. he thinks they're buys. Joining me now, Justin Keywood, healthcare and special situations analyst at Stiffel Canada. Justin, thanks a lot for joining us. What do you, in this context of trade tensions between us and the United States and the strong possibility of very damaging tariffs being placed on Canadian exports to U.S., what do you look for in terms of stocks that may actually prosper in this type of environment?
Good morning, Paul. Thanks for having me. And absolutely, the tariff situation remains fluid, but the threat of is creating havoc on the market and stock valuations, and that's creating some good investment opportunities. So we're looking where there's some misconceptions on securities, and that's where we see the opportunity.
Okay, one that you like, ATS Corporation. It's an automation provider. It, as I see, has about 80% of its sales tied to life sciences, food and beverage, and nuclear. Ticker symbol ATS. Why do you like this one?
Absolutely. Well, ATS, end-to-end automation provider. So they design, build, and service high-performance robotic systems, replacing manual labor. And why do we like the stock? Well, we see ATS as a net beneficiary of potential tariffs, because that's only going to bolster an onshoring or nearshoring trend, where domestic manufacturing, as that increases, automation is likely going to be needed, and it's setting up for some real long tailwinds. We also like the fact that there's a good growth baked in from GLP-1. So this may not be clear, but ATS provides the automation lines that manufacture the auto-injector pens for GLP-1. And that's going to help overall growth very shortly. So there's a couple of reasons here and some misconceptions on the name as it relates to tariffs.
Interesting. You've got a $52 target on this price, which is about $10 north of where it is right now. What kind of valuation metrics do you use to get to $52?
Absolutely. Well, right now the stock's trading at about 12 times forward EBITDA. We see that re-rating to about 14 times over the next year. And right now, the automation peers, it has very favorable valuation. Some of the U.S. peers trade up at 20 times because of that secular trend on onshoring and nearshoring. And with the mix shift change underway within the business and that GLP-1 growth starting to lift overall financials, we think it should get near our target price very soon.
Okay, number two, Jamieson Wellness, the well-known maker of vitamins and supplements. Why does Jamieson fit the bill in this context?
Absolutely, 103-year-old pure-play Canadian vitamin business. And the company is looking to leverage its dominant market share position in Canada into new international growth markets. And why we like it? Well, it goes back to my earlier comments. There's misconceptions as it relates to tariffs on this stocks. There is about 10% of sales that are exposed, but it's very low margin third-party revenue that doesn't have really that much of an impact to EBITDA. Jamieson does have U.S. business at about 20%, but that revenue is contained in the U.S. with distribution and manufacturing out of Irvine, California. So because of these misconceptions, the stock has seen some substantial pressure this year, and it's trading at multi-year lows at 10 times EBITDA, where some of the consumer health peers, they trade 50% higher, and VMS takeouts continue to occur at about 100% higher.
And number three, Well Health Technologies, ticker symbol WELL in Toronto. It's an owner and an acquirer of medical clinics.
We continue to favor the Well name. It had a good run last year. So as you mentioned, growth by M&A story. They have the #1 market share in Canada for primary and specialty care clinics. And why do we like the stock? Well, one, there's no tariff risk here, right? Very recession resilient business model focused in healthcare, acts as infrastructure. And then we also favor the consolidation opportunity. Well has the #1 share but only 2% of the primary care market is consolidated in Canada, and that compares to the US at over 55%. So there's a long runway to grow here.
Justin, thanks a lot for speaking with us today. We appreciate it. Justin Keywood is healthcare and special situations analyst at Stiffel Canada, with 3 stocks that he thinks can do well amid trade tensions with the United States. Coming up, a conversation on a weaker consumer and